The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
The taco traders and the dip buyers get it right once again. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in New York. Much different picture than 24 hours ago. You can see the S&P 500 at session highs right now, higher by about 1.6%. Even better when you take a look at the NASDAQ 100. We saw a big burst of energy after President Trump said that he has a framework deal for Greenland. So we're going to try to unpack that a little bit, but you can see the market reaction here. I did want to highlight the 10-year Treasury yield cooling a little bit, dropping by about 4 basis points, a bit of a rally in the bond market. Meanwhile, volatility draining out of the equity market. The VIX down by more than 3 points. We are trading with a 16 handle, Romaine.
Love them or hate them. The retail traders, Katie, they got it right once again. Remember, they dove into yesterday's sell-off, and that has paid off once again as Trump's dialing down of all that conquistador rhetoric, giving the bulls a bit more breathing room to run. Now, it was not a linear shot higher, though. The market rallied about 1% earlier in the session, but by about noon, it had given back most of those gains. But then just about 30 minutes ago, as Katie said, the redhead on the Bloomberg stating Trump was backing off his latest tariff threats on Europe and seeking to work with NATO on some type of framework of a deal over Greenland. Now, of course, that doesn't mean that the uncertainty and risk is out. It still lingers on the question of tariffs, on the question of Greenland, and of course, on the question of Fed independence. A U.S. Supreme Court hearing today showing justices reluctant to definitively resolve the main constitutional issues from Trump's effort to fire Fed Governor Lisa Cook, the potential for an ambiguous ruling. That means for some investors, they see the Fed continuing to be that convenient punching bag for the White House, which is relentless in agitating for immediate and aggressive rate cuts.
They would like to see long-term interest rates lower because it benefits companies and individuals. And so if that's the objective, then making sure that we're keeping the Federal Reserve sort of a little bit out of the news and not super controversial, I would personally say would be in furtherance of that objective.
Now, all told, we should point out the market mood is still a little bit shaky. The majority of stocks are in the green, but defensive plays like gold, they're still at record highs. Software stocks, they're selling off for a 7th day, the longest losing streak since 2022. Microsoft, Oracle, Palantir sitting this one out. But the beacon light, it remains the Russell 2000. Small cap stocks, Katie Greifeld, continuing to shake their moneymaker, outperforming for a 13th straight session. I don't have enough fingers for that.
Incredible. The little guys, they are the big winner in this market. But even still, I wanted to take a look at the cross-asset picture here, because yesterday, again, it was a very different picture. We were talking about Sell America, and you can see that reflected in the chart right here. Now it's a little bit of a different story. Sell America looking for the floor. Maybe it found it, because you take a look at the price action so far today. In blue, you have the S&P 500 futures there. You have the Bloomberg Dollar Index in white, and then you have U.S. Treasury futures in yellow. And you can see, again, that spike up that we saw. We bottomed out a little bit overnight coming into today. And now it's sort of off to the races, especially when you take a look at stocks. Of course, as you mentioned, though, Romaine, there's a lot of risks, a lot of questions out there. So we'll see, of course, whether or not there's a ceiling here as well.
Yeah, and it feels like the last couple of days a testament to long-term investing. Joining us right now to kick us off to the close is Binky Chadha, Chief U.S. Equity and Global Strategist at Deutsche Bank Securities. Binky, great to see you here. Let's first start off with the immediate and a lot of these short-term moves here. And the idea of a market that seems to think that they've kind of figured this White House out, right? You make these grand threats. At some point, you either renege on them or you dial it back to some degree or another. At least for today, it appears the market got it right once again.
Yeah, I would put the focus a little bit differently. We are in a midterm election here, and you've heard the saying that, elections are about the economy. There is a word at the end. It's in quotes.
Yes, yeah.
Which means that that's what you should focus on. And what I would argue is, we have a data series that asks people, how do you feel about the economy? It's called consumer confidence. And so I would argue presidential job approval ratings, which, current president's approval ratings actually fell to a new low last Friday. At the end of the day, what's going to drive is basically people's perceptions of the economy. And so it's kind of hard to imagine that we're going to do something that is bad for the economy and therefore bad for earnings, and earnings, of course, the anchor for the equity market. So I would argue, if anything, the bias will be the reverse. So I think the initial, or the first set, I should say, basically of initiatives like putting a cap on credit card interest rates, institutional investors not being in the housing market, they're all aimed at the same thing. I'm not so, and because of the approval ratings where they are, and they haven't really moved up yet. I would expect such initiatives to basically continue, and so what you're kind of seeing basically in the equity market, looking at it from a positioning point of view, is we've had the fundamentals-based investors. We call them discretionary investors as opposed to systematic. Discretionary investors have been hugging neutral for 6-8 months now. And so they're likely to sort of stay here, given the jitters and the risks that you spoke about a second ago. But, even during these events in this period, our view and take was, they're not going to suddenly go underweight. I mean, they've been sitting because the risk is two-sided. The memory of the speed and strength of the recovery from the Liberation Day sell-off.
When you talk about going underweight, though.
Yeah,
But you're talking about primarily.
But they're unlikely to go overweight anytime anytime in the near future. So, a lot of the price action is just coming from systematic strategies and what's happening to vol. And you just mentioned how the VIX just collapsed. So, and we're not quite back to where we were, but it's not far.
Well, Binky, I want to talk a little bit more about the administration's sort of reaction function here. What cues they're queuing off of, so to speak. So you mentioned, of course, approval ratings. That seems to matter to the president. How do you think his relationship with the market has evolved? Because, I mean, you think about how the notion of the taco trade even came about. It was this idea that President Trump would be restrained somewhat by the market reaction. And I mean, you take a look at just the past several weeks, the past several months, it seems that that's lessening a little bit, that correlation here. But I wonder what you make of it.
So, I mean, there's, other elements of the framework for thinking about this. And the other key one is, of course, you're going to get these initiatives that might upset the market, but you're typically going to get them, which is a lesson from Trump 1.0, when the market's at a new high. We were at a new high very recently. So that is an emboldening, aspect of things. So I think, this game is going to go on, and the approval. I mean, the current approval ratings. I mean, you can just look at history. The regression line is pretty clear.
Yeah, they've got to do something on the political front.
Because I mean, the current approval ratings, the current generic congressional ballot tells you that Democrats are on track to take 25 to 40 seats in the House. That's a big number.
But I'm curious, though, as far as like the market fundamentals themselves, to a certain extent independent of whatever the heck is going on at the White House and in Congress, we saw this big sort of embrace of small cap stocks. It seemed to kind of start towards the end of last year. It's been relentless at the start of this year, even on a day like today where you have an S&P up 1.5%, the Russell's up almost 2%. What is that about? Is that just valuation, bargain hunting, economic fundamentals, what?
So I would actually say it's about something else. It's really what began with third quarter earnings, which of course we got into the fourth quarter, so late last year, and it's really about the broadening out of growth. If you rewind the tape to the second quarter, you have the S&P 500 delivering 9% earnings growth. And you say, wait a minute, let me look at the 11 sectors in the S&P. So we're talking about 9% S&P growth, S&P 500 earnings growth, but we have only 2 sectors with positive growth. By the third quarter, that had become 6. We are looking for in fourth quarter earnings, which have just begun, basically, for 9 sectors. So it's really about a broadening out of growth. That's where the small caps come in. Number one. Number two, we just talked about the incentives to try to get confidence up. So small caps are a beneficiary of that in some sense,
Yeah.
and that's where you take aim. So there's other elements.
Right.
I mean, S&P 500 is very top heavy and
well,
very concentrated. This is less. So for all the things that are going on, I mean, one thing that we didn't speak about, so we talked about neutral positioning for discretionary investors. What is also very remarkable, and especially when you look at a chart, you say that's just amazing, which is if you look at sector positioning, so we had cap on interest rates, very bad for the financials.
Yeah.
We had housing, bad for another part of the financials.
Yeah.
We've got, I can go on. There's a lot of basically, bombs in portfolios that are, appearing very suddenly. And so that's an incentive basically to pair positioning towards neutral also at the sector level. And what I would say is, if you look at our measure of positioning for mega cap growth in tech, it was obviously, a notable, if not sizable, overweight. That has come down all the way to neutral. And if you look at the cyclicals, positioning was, very short and underweight. So the small cap question, it is now risen basically up to neutral. So there's a lot of position squaring going on, and I would not have expected basically to see everything start going to neutral. But maybe that's where we go if things quieten down on the administration side.
Yeah, if they
then
quiet
maybe
down.
people will go back to taking bets. But right now, the market, fundamentals-based investors are position neutral. They've been this way for 6, 8, 10 months.
Right.
And now we're seeing even sector positioning and bets coming off. So some of the beneficiaries of what you're saying is, what we're seeing is just really a covering of those underweights for the new environment. At least a fundamental underpinning, which is the broadening of growth. It's happened so far very clearly only for one quarter, so we have to see, but our expectation is it continues in the fourth quarter.
All right, Binky, we have to leave it there. And just a note here for our viewers, Trump continuing to talk about that Greenland deal, saying that the framework is a long-term deal and that it puts, in his words, everyone in a good position, and that the framework is a deal that is, quote, in his words, forever. Binky Chadha, Chief U.S. Equity and Global Strategist over at Deutsche Bank Securities, kicking us off to the close. A lot more coming up, including a closer look at the M&A environment. Morgan Stanley CEO saying he's pretty amped about M&A. We heard from him at Davos. We're going to hear just a bit from Bill Curtin, one of the biggest advisors here in the M&A landscape.
And from mergers and acquisitions to major fundraising rounds, why Churchill Asset Management is going all in on senior lending. We'll discuss with CEO and President Ken Kencel.
And from direct lending to the real estate space, the conversation up ahead with Chinese billionaire Zhang Xin, founder and CEO of Closer Properties and the former CEO of Soho China. You don't want to miss those conversations. All that and more coming up in a bit here on The Close. This is Bloomberg.
Let me be direct. We are in the midst of a rupture, not a transition. Over the past 2 decades, a series of crises in finance, health, energy, and geopolitics have laid bare the risks of extreme global integration. But more recently, great powers have begun using economic integration as weapons. Tariffs as leverage, financial infrastructure as coercion, supply chains as vulnerabilities to be exploited.
An excerpt from Mark Carney's speech at Davos, sounding the alarm on what he called extreme global integration, saying the use of tariffs as leverage is damaging the global economic landscape. Joining us now to talk a little bit more about U.S. policies and its approach to the global order is Oliver Libby, managing partner at the impact fund HL Ventures. He's also the author of a new book, Strong Floor, No Ceiling, a book about reigniting the American dream for what he calls the radical center. I do want to put that context, that book, in the context of the global order that Carney hit on yesterday. This was probably one of the most pointed speeches I've heard from a world leader in this sort of Trump 2.0 era, addressing at least what Carney says is basically the end of an era. And now, at least for mid-countries, like he refers to himself, having to start anew, something fresh, something ideally, I would assume, that does not necessarily include the U.S., at least not to the extent that it did in the past. What did you make of that speech?
Look, I think at this point, we're in the middle of this, and there are ways we can back off from it, because I do think that the world order that we really paid for in blood and treasure in World War II, and that has been the underpinnings of the American century, is important. And it's something that, it's funny, I wrote Strong Floor, No Ceiling for America, but there's actually a big, long foreign policy and defense chapter. And if you think of Strong Floor, No Ceiling in the international context, there needs to be a floor of credibility, of systems, institutions that then let things like trade, peace and security, the kinds of things that America has really helped steward for the last century, essentially, go forward. And if we're going to flip the board over on a game to which we design the rules, we should do that very thoughtfully.
Okay, but we're not. I mean, and we can just say that flat out. We're not, the U.S. And when I listen to Carney's speech, he talks about this idea that those rules, to a certain extent, were always a bit false, right? I mean, we benefited from them, but in his view, he was saying there was always this idea that the only way those rules were real was if we believed in them. And he made the point that, at least right now, we don't believe in them. Certainly not the U.S., at least coming from our official policies. And a lot of other countries around the world are saying we don't necessarily believe in them as well. What does a reimagining of that world order end up looking like? Is it a regional sort of powers where the U.S. controls the West, the China controls the East, or something like that?
Look, there's this sense in human history that there's just this upward trajectory, that everything gets better over time. But we know that's not always the case. There have been times in history, the Roman Empire, when it ran, into the ground, led to the Dark Ages. And it's incumbent on us to not allow that to happen again. And the kinds of international systems that you're talking about, they prevent those sorts of things from happening. International relations, I don't think, moves incredibly quickly. It takes a lot to unseat these things, although it's always easier to destroy than it is to build. Mm-hmm. But I think, you're right. I mean, over the last few months, we have seen not just chipping away, but hammering away at this world order that has been so beneficial to us. You said something, Romain, that I think is right on. These sorts of rules only matter when we believe in them. And America has generally believed in these things and then acted behind that belief for the better part of a century. We have to decide, and we're going to have some decisions to make, for example, this coming November, how much we still believe in those things, how much it matters to us that the world looks to us for the moral high ground generally. Not that we've been perfect forever, but that we're always trying to do the right thing as a country, looking to our defense companies and our industry to arm them and energize them and innovate for them, looking to our dollar as the reserve currency. These are things that are investments that America has made. They're not things we've given away. They're things that we get because we set the rules to that game. And that's something we should be very conscious before we give up.
When we think about those elections coming up in November, let's bring this conversation a little bit more domestic, because you think about the framework of strong floor, no ceiling, and you think about what President Trump has really been focusing on. It's affordability. That was supposed to be the subject of his speech in Davos this morning, but we know that he's taken aim at housing, various proposals there, at credit card interest rate caps in the name of affordability. So how does that push fit into this context?
Well, first of all, affordability is one of the key planks of a strong floor. And if we have a society where things are basically affordable, it actually helps remove the ceiling, right? When people have what it takes to feed their families, then they can think of starting a business or inventing something. It is, in fact, the fundamental inside of the book. So affordability is critical. And look, the president has indeed turned his attention to that. I think some of these plans, the way that the president tends to do these things is he will issue a proclamation, right? That, there's going to be a cap on interest rates that credit card companies can charge. I think we all know that for that to actually take on force, it would need to become a law. And then it will have ramifications. I mean, for example, the credit card companies aren't just going to say, fine, we're going to cap all the credit cards, but everything else stays the same. I mean, credit is issued based on risk analysis. And if the risk becomes very high, then they're going to stop lending, the banks that issue these cards. So the president and the administration and the Congress traditionally would work together to actually create a thoughtful approach. And I think the jury's out on whether that's going to happen, but a lot of these things seem from the hip. And I think that's not going to solve the affordability crisis. And one last thing to draw this conversation together. Yeah. The American people, most people around the world, right, are worried first about the inner concentric circle. Can they feed their families? Do they have to work 4 jobs to make a family work? If we're not going to help families with that by providing the planks of the strong floor that I write about in the book, then it's very hard for us to ask those same families to care about norms of democracy and NATO and the international system post-war. And so I think affordability is actually the key to us becoming believers once again in the things that you talked about, Romain.
And before we let you go, I'm curious about how this has impacted your business. So, of course, we're talking about HL Ventures. It was founded in 2009. As I understand it, you do a flavor of impact investing. So you think about the first Trump administration, now we're in the second Trump administration. How has that changed things at all when it comes to how you invest?
Well, look, for us, I mean, we are investors in startups, so our horizon is very long. But we depend on a few things for this to work really well. First of all, predictability is important. Predictability is something that public markets investors like as well, right? But also they can trade the dips on the day. Long-term private hold, we need the market to be prepared to buy startups from time to time. And I think, it's no surprise to your audience that for the last 3 or 4 years, it's been very hard to sell most startups. I mean, there's a huge backlog. You look at a few marquee IPOs aside, a few big investment rounds aside, most of the innovation sector in America has been kind of frozen for the last 4 years. And that is bad news. Not only that, but if we choose as a nation to, for example, defund public science and bench research, that's 30 or 40% of the innovation pipeline for and innovation coming out of universities for the startup and venture capital industry. So look, our industry depends on a historic partnership, public-private partnership. It depends on stability in the market so we can plan long-term, because what is the one thing that businesses hate more than regulation? It's uncertainty. And uncertainty is the name of the day today.
All right, Oliver, I have to leave it there. Great stuff. We need to get you back soon. Oliver Libby, managing partner over at HL Ventures and the author of Strong Floor, No Ceiling, Building a New Foundation for the American Dream. Stick with us. Some breaking news now on President Trump, commenting on the Fed chair, commenting on Greenland and mineral rights. Big market moves when we come back after the break. This is Bloomberg.
Let's get to some breaking news right now. President Trump saying that the U.S. will be involved in Greenland mineral rights. Let's break it down with Bloomberg's Balance of Power host Joe Mathieu joining us now. We have headlines when it comes to Greenland, of course, minerals. We also have headlines when it comes to the next Fed chair. President Trump saying that Rick Rieder and Kevin Warsh all good for the next Fed chair. So some news when it comes to Greenland and also that short list getting shorter, Joe.
He's been making a lot of news today. This is from an interview on another network. He's talking to CNBC about the concepts. This is the language he used, concepts of a framework for a deal around Greenland. We have to be just clear about some things that we do know and what we're hearing from the president, while acknowledging the elements of this deal that we don't yet understand. But indeed, the president saying that the U.S. will be involved in Greenland mineral rights, which is something dealing with rare earths and minerals the president talked about in his speech in Davos today, and in fact played it down, suggesting that the national security implications and the United States' ability to militarily protect Greenland was the real reason why we needed to take over that territory, saying that he hopes as well that there will not be further action in Iran and that Iran cannot pursue nuclear, as he put it. With regard to the Fed, he said, I like keeping Hassett where he is, which is kind of interesting, reiterating his recent comment that Kevin Hassett, as his economic advisor inside the White House, may well stay in that job, as the other Kevin is looked at more closely, considering his references to the two Kevins. Kevin Warsh, and to your point, Rick Rieder, we could get, Romaine, an announcement, according to the administration, as soon as next week.
Yeah, Trump also saying that he wants Bessent to stay where he is, so not a lot of upward mobility there, and also saying that if Powell won't leave the Fed, he won't make his life happy. I do want to sort of pivot, though, to something else that Trump is talking about, and that goes back to the credit card cap. He's talking about that now in that interview. But also, he mentioned this in his speech at Davos. And one line that I seized on, and a lot of traders seized on, was when he actually said he would go to Congress to seek the authority to impose that credit card rate cap, which, as the Constitution says, that's what he has to do. But, of course, that's not how he originally pitched this. Should that actually be taken as kind of maybe a signal that he is thinking about this a little bit more introspectively?
Well, it certainly acknowledges, I think, some of the pushback that he's getting from Congress on this. The banking lobby just sprung into action after he made that social media post. And by the way, we'll remind everybody, Romaine, he said that needed to be done by yesterday, by the anniversary of his inauguration. And of course, credit card companies have not done that. If this takes the form of legislation, and there already is a bill, a Credit Card Competition Act that we've talked to Roger Marshall and others about in the Senate, they don't seem to have the support of Republican voters in this case. This is a page straight out of Elizabeth Warren's book, and it's not clear that the president will have the support of his own party on that.
Yeah, and to that point, President Trump saying that credit card companies need to give people a break. Also getting more headlines here, President Trump saying that basically they will sell Venezuela oil at market price, keep some. And it really drives home the point, Joe, that this administration is very focused on foreign affairs. You think about President Trump at Davos right now. We're talking about Venezuela, we're talking about Greenland, and of course, Russia and Ukraine remains an issue as well. You think about heading into the midterms, the criticism does exist that this is a president that is much more concerned about what's going on in the rest of the world than issues at home.
Well, that's right, Katie. And of course, the administration would tell you, and we had a conversation with a State Department spokesman earlier on Balance of Power, that these actions, specifically around Greenland, are about America first. But I'll also point you back to a story on the terminal. Susie Wiles, the chief of staff on Air Force One last night, telling reporters on the jet overseas that President Trump is going to begin traveling weekly. In fact, he's going to start his travels next Tuesday on the road and will be out weekly, I guess, until further notice.
Wow.
Hammering home the message on affordability. Yeah, Romaine, it looks like the road tour
does Trump
is
know
back.
that?
That's a great question. Look, everyone says inside and outside of the White House he's happiest in front of a crowd, and it looks like he's going to have that opportunity.
All right, Joe, Mathieu, really appreciate you breaking down these headlines. That is Bloomberg Balance of Power co-host Joe Mathieu. You can catch him at 5 p.m. Eastern. But another big topic of discussion at Davos is the booming M&A landscape. Morgan Stanley CEO Ted Pick saying on Bloomberg earlier today that he's, quote, amped up about his M&A outlook. Let's take a listen.
I'm pretty amped up. You know, we had several years where the M&A activity was going to get going, and then COVID happened, and then rates roofed, and it's taken a while for it to unglue. But this kind of, in this case, literal noise speaks to C-suite need to act. As long as there's activity, we're busy. So cross-border M&A, large cap M&A, going to be important.
Well, for more on the 2026 outlook, let's bring in Bill Curtin. He is global head of M&A over at Hogan Lovells. It's great to see you in person, Bill.
Good to see you, Katie. Good to see you, Romaine.
So Ted Pick, he's feeling amped up. Do you feel the same?
Oh, very much so. Ted actually said he's feeling pretty amped up, and I think he could take the adjective pretty out and just say he's amped up. He's got reason. We had green shoots coming through, Katie, last year. We set some records at the end of the last year on the value component of M&A deals, not as much on the volume. The number of deals that got done was still down year on year in 2025. But we had more deals conclude and sign in the last quarter of 2025, a value of over $10 billion than ever in history. All the economic criteria are in place, right? We haven't had runaway inflation that people feared as a result of the tariffs and Liberation Day, right? We haven't had, I mean, we've had the geopolitical things even today, right? But we've still had capital markets resurge today, even with the framework helped us there. We have cost of capital that's very tolerable, available capital. So everything's in place. There's tremendous momentum and confidence in the marketplace. So I think we're going to have a record-breaking 2026. I really do. And I think in the past, Katie, we've had these multi-year runs of M&A. The difference this time around is I think the multi-year run that we're about to start here is going to have an even higher ceiling.
Interesting. And I mean, you mentioned that in 2025, we really saw the return of mega deals, if you want to call them that. Is that something that's sustainable, or do you chalk that up to maybe pent up demand, given that for a while we weren't seeing deals get signed?
I'd say yes and yes. I'd say yes and yes. There's so much that's pent up, particularly on the sponsor side, Katie. The strategics have been moving along. The sponsors have been, as we know, chomping at the bit and ready to go. But I'd say yes and yes because there's pent-up demand, but then there's also been an unfurling and unlocking. Remember, FTC Chair Ferguson said in the fall of 2025, the FTC needs to get out of the way and get out of the way quickly to clear transactions where they can. Early termination approval from an antitrust perspective of transactions was reinstituted right after it was taken away during the Biden administration. And we now have regulators who are saying, how can we get deals cleared rather than should a deal just be approved or blocked?
I'm wondering if you could talk a little bit more of that, because it's interesting, too. I mean, going back to Ted Pick, one of his deputies, I thought said something really prescient a couple weeks ago. He was talking about loose financial conditions, fiscal conditions, loose monetary policy conditions. But he said that the real driver, in his view, for deals has been what he said is basically easier regulatory conditions. And he kind of framed it around this idea that that's kind of the third leg of this stool that's really been driving things. Do you think that the Trump administration, based on what we know publicly, is going to stick by that.
I do think they will, and I do think that observation is absolutely right. It's hard to bet against America when there's opportunity in front. Regulation, over-regulation inhibits opportunity in front. So we have in America right now, by the way, this past year, 50% of global deal-making connected to the United States of America. That's the highest percentage in 30 years, okay? So we have in America right now, Romaine, it's sort of like sitting on the hilltop, right? You've got great visibility, predictability, because you know if you take a transaction to the FTC or the DOJ, they're going to look for a way to clear it if they can. They may have behavioral remedies, it may have structural remedies, but the advisors can anticipate and predict that. And as soon as we give C-suite individuals predictability to do deal making, they can go transfer their business through AI, which they greatly want to do. They can reshape their business globally according to their wishes, right? And they can keep pace with their peers. So predictability is the key, and I think this administration, rightly in my view, has made that more of a thing in the M&A world.
When we talk about M&A deal activity, and more importantly, not just the value, but obviously the number of deals, is that going to be across the board in terms of sectors, or do you think it's going to be, there are going to be certain sectors that are really going to take a bigger concentration of those deals?
I think every single sector that involves technology, in other words, every single sector is going to lift.
Okay.
I think there are 14, 15 sectors by most of the banks and the law firm advisors, but there's really one sector, and that's the imperative of technological change, right? We are in an environment right now, I've renamed M&A to be M&AI, right? Because we're in this new imperative where you're looking to the left and you're looking to the right, and you've got FOMO and all the, you keep moving, and M&A is the great propeller to embrace technological change.
Well, we only have about a minute or so left with you, but you mentioned FOMO, and I was watching an interview you gave on CNBC at the end of the year where you were talking about how there's a big psychological element when it comes to M&A. So you think about pent-up demand, you think about FOMO. Is there a potential here that things get a little bit frothy and the quality of deals maybe goes down a little bit?
Well, the thing that can happen, and as you turn the page and look forward, right, Katie, the thing that can happen is things get so frothy that then the valuations shoot up, right? And then that becomes its own inhibitor because then people feel like they're overpaying for assets, right? So that can slow things down a little bit, but only a little bit. I mean, the momentum piece, the psychological piece, what our sisters and brothers are doing around us in a sector is such a great imperative. And then there's that time-old tradition, that component of the human condition, which is momentum and confidence. And it's a visceral thing, and you can feel it. That's why Ted spoke the way that Ted spoke in Davos, right? That's why you heard Trump, before he even got to Greenland, it was a customary Trump maneuver. He started out his speech by iterating all the superlatives about the U.S. economy, where inflation is, right? The $20 trillion of investment in the United States of America, right? Unprecedented. That, in my view, was all a setup for him to go make his ask that he wants Greenland. And within hours, he's communicating that he has a framework deal. It's quite remarkable.
All right, Bill, always great to catch up with you. Always great insights. Bill Curtin there, Global Head of M&A over at Hogan Lovells. And, of course, we talk about all the big lawyers out there and advisors championing at the bit for M&A. Well, guess what? Direct lenders are also anticipating what could be a potentially record-breaking year as well. Churchill Asset Management just announcing its largest fundraising in its history. A conversation up ahead with the CEO and President Ken Kencel after the break. This is The Close on Bloomberg. In just about 20 years, Churchill Asset Management has grown from nothing to, well, everything. Just today, it announced its largest fundraise in its history, raising more than $16 billion in commitments for one of its newer senior lending programs. Joining us right now is Ken Kencel. He's the CEO and president of Churchill Asset Management. Ken, great to have you here.
Great to be here.
I always like to talk about your origin story because I'm always so fascinated. But let's talk about the here and now. You got $16 billion in your pocket, more or less here.
Yes.
It's not just the fact that you raised that amount of money, but put it in context relative to the previous vintage.
Sure.
And the idea of what's actually transpired over these last 3 or 4 years with regards to the direct lending space.
Yeah. Well, look, I think it's interesting. I mean, if you look at the evolution of direct lending and private credit and senior lending, that we do, I think you've seen a tremendous growth in institutional interest. We're up about 35% from our prior fund. And despite all of the noise and some of the headlines you've seen in the fourth quarter, the reality is Institutions are continuing to increase their commitments to private credit. If you look year over year, another year of increased commitments to private credit, and I think it's a recognition that the value proposition is quite attractive today.
So what was all the grumbling about over the last year or so?
Well, the grumbling in the fourth quarter, as you and I know, we talked about this in a prior discussion, was really in and around those deals that had problems, right? So there was Tricolor and First Brands and some of those other deals that ran into issues, but they really weren't private credit deals at the end of the day. They were really more broadly syndicated deals. So as institutions and investors got closer to understanding what was really going on in those transactions, in one or two cases there was fraud, I think there was a recognition that actually the overall credit quality in portfolios is very good, and deal activity continues to be very active. We were up, 80% in the fourth quarter year over year in terms of deal activity. So M&A's picking up. I heard Ted Pick's comments earlier. Very much agree with them. I think 2026 is going to be a very, very active year.
Well, given that it seems like activity is increasing across the board, let's talk a little bit about competition here.
Sure.
Because you closed out this fundraise. I know that this is something that you started at the end of 2022. What does the competition look like when it comes to deployment opportunities? Where are you finding those?
Sure. I would say that we focus only on private equity owned companies, right? So our world is sponsor-backed M&A and buyouts in the core middle market. But I think that what has happened from a fundraising perspective is the larger players are raising more and more capital. They're institutionally validated. The brands are raising more capital from a retail perspective with individual investors. And I think it's a bit of a it is a bit of a dynamic where the rich get richer, right? The larger platforms are raising more capital. They're able to commit more in transactions. And so I think the competitive dynamics favor large-scale platforms that have institutional relationships. So it's certainly competitive in terms of putting capital out there, but I think the firms that have differentiated sourcing and relationships are really leading the way. And deal flow, you can see, as I said, we were up 80% year over year in terms of deal activity in the fourth quarter.
Well, let's talk a little bit about where you specialize, and that is those middle market companies. What is a middle market company in this day and age, and what sectors do you particularly like?
So, first of all, as we define it, middle market would be companies with 10 to 100 million in EBITDA. So these are companies that are larger than the kind of local regional businesses or small cap businesses, but not so large as to have graduated into the syndicated loan market. Where do we see opportunity? I think the reindustrialization, anything in and around financing businesses that are really playing into the technological revolution that we're seeing. We don't finance data centers directly, but we've got $6.5 billion invested in companies, that's middle market companies that support data centers and invest in those. Healthcare, business services, software, all very attractive areas for investment, and we're seeing a lot of increased M&A activity to support that.
You started off this talking about kind of the commitment by institutional investors to staying invested in these types of assets. I am curious about individual investors and the wealth channel and the potential growth that everyone seems to be talking about these days. Is that something that Churchill is leaning into?
Absolutely. Yeah. So if you look at the wealth market today, it's about a $70 trillion market. You think about that's only the individual wealth market, not even counting retirement and the potential move into 401ks and 403bs. So that's a whole nother move that I think we'll be seeing. But if you look at the overall wealth market, it's about 50% of the investable capital overall, but less than 20% of the underlying allocation to wealth, so to alternatives. So I think there is a huge opportunity in wealth. Obviously, all the larger players continue to lean into that space, and I think it's going to continue to be a driver, along with insurance, in growth in private credit.
All right, Ken, great to get some time with you, especially on today, which I know is a busy day for you. That is Ken Kencel. He is CEO and president of Churchill Asset Management. Meanwhile, we take a quick look at what's going on in these public equity markets. The S&P 500, it's off of its session highs, but still, we're looking at a gain of about 1.2%, Romaine.
Yeah, Katie Greifel, that's nothing to sneeze at here, but I'm going to one-up you on that here. Once again, a big focus on the cyclical stocks, a big focus on the small and mid caps, outperforming once again. I don't know if you're keeping count.
I always am.
It's been 13 straight sessions.
Incredible. Yeah. Those small caps really giving the large
all the
guys.
way back to before I was born.
Unbelievable. Anyway, we'll take you through all the closing action. Up next, Alli McCartney. She joins us from UBS Alignment Partners.
I tell that joke every day.
This is the close.
I think there is going to be some marginal move away. And I would say they are looking to diversify away from U.S. assets. And I would kind of describe it as quiet quitting of U.S. bonds. I don't think there's going to be a massive announcement. I just think they're going to look for opportunities to diversify away.
Katie Koch, CEO over at TCW, really putting into context here what I guess started off as a Sell America trade. That might be a bit of a too broad category, but I like her phrase, idea of quiet quitting. That this isn't necessarily going to be a selling of U.S. assets, but the idea that the accumulation of new U.S. assets might be curtailed just a bit.
Yeah, maybe we just won't buy anymore. I haven't heard that applied to the Treasury market before, so definitely like that one. You're not seeing that today, though. You have a very slight rally going on when it comes to Treasury. So overall, the 10-year Treasury yield down by about 4 basis points, not quite climbing out of the hole that we saw yesterday. And you can say the same for what we're seeing in the equity market right now. A bounce back, to be sure. The S&P 500 higher by about 1.1%. And that small cap outperformance, even on a down day, continued yesterday, and it continues with an up arrow today. The Russell 2000 higher by about 1.8%, Romaine.
Yeah, and this seesaw that we saw from yesterday's big drop in equity and risk assets, at least, and of course now the big rebound that we're seeing, it really gets to this idea of what investors really want out of this. You know, we pay so much attention to everything Trump says, everything that's coming out of the White House. And I think the last 24 to 48 hours was kind of a lesson that you kind of just have to keep your eyes on the long-term prize here and understand that the incremental stuff, it matters, but to a certain extent it doesn't.
That being said, I did find it amazing that the S&P 500 and the NASDAQ 100 did move on those Greenland headlines that we've got in the past couple of hours. President Trump coming out and saying he has a framework deal, some sort of deal. That was enough to move the U.S. equity market. So
I'm a little confused. So a framework for what?
Well,
to take it over? Because, I mean, I listened to a speech. I actually listened to it from start to finish, which is rare, because I was really, like, on edge like everyone else. I wanted to hear what he had to say. But he just kept calling it, like, a dirty piece of ice, and nobody needs it. But then he says, but we want it. And I was like, well, I mean, come on, dude.
Well, he said that the U.S. is going to be involved in its critical minerals deposits. So, yeah, I'm not sure. I assume you have to take over the whole piece of ice in order to get down below it.
Well, he said that they're very down there. They're not so rare, and then he ranted about windmills. Let's keep it going here as we move closer to the closing bells. A bit of a rebound rally, and we should point out we have not recouped all of the point losses from yesterday's sell-off, but a good start here in getting back to the waterline. Alli McCartney joins us right now, Managing Director of Wealth Management and Private Wealth Advisor at UBS Alignment Partners, helping us count you down to the closing bells. And Alli, I do want to kind of put this into context. I know for your job, you're very much focused on the longer term outlook here for what it means for your investments. But when you look at a lot of the short term ructions and the way that it bats around the market, how do you handle that psychologically, not only for yourself, but for your clients?
That's a great question, and especially as someone who went through the Lehman bankruptcy and an over-the-counter derivatives desk, it is how you do it emotionally and how you do it in public. Look, here's what I would say. As we have seen in the last 24 to 48 hours, this is an individual who likes to, A, negotiate in public, and B, create a lot of noise. And so that has been a learning and adapting process for U.S. investors to understand what that means and to try to separate and tease out the noise from the policy. In this case, there seems to be, or markets are telling us, that this was a lot of noise. We happen to be doing this, I think, nicely in an earnings season, which is going extremely well, and underpinning the fact that this bull market that began in late 2022, the things that are motivating it and sustaining it have not changed in the last 48 hours.
Well, I am curious, too. I mean, as you get deeper into earnings season, and next week is going to be big as we start to get really the biggest of the biggest caps out there, like your Microsofts and Apples of the world. It gets to this idea as to where expectations are this earnings season. Are they in line with where you think they should be? Are they too high, too low?
So we're a little bit below expectations for bottoms-up Wall Street for both 2025 and 2026, but that still puts us in double digits, right? And so when you're talking about a market that is trading at the highest multiples, in the 1% of the 1% of history in terms of priciness and richness, and there are certainly concerns about, is it over-positioned? Is there enough risk premium to keep on driving investors? These things are really important. Earnings growth is what matters, right? And so here we sit in a backdrop that is very supportive fiscally from the Fed's perspective, from AI and infrastructure build-out perspective. So what we need to see now is not only earnings continuing and materializing in the sense that they are, again, in double digits, but you also need to start to see the productivity accreting and broadening out, both throughout the market, but into the users of AI, not just the hyperscalers and the practitioners.
Well, in addition to earnings, I'm really curious to get your thoughts on what's going on when it comes to the race for the next Fed chair. We heard from President Trump earlier today saying that we're down to 2 options potentially. I can probably tell you we're down to maybe 1 in my mind. That's a quote from the president. Rick Rieder and Kevin Warsh are good options, according to the president. How closely are you watching this race at this point?
Again, there's a lot of noise and pageantry in general in the way that the relationship that Trump has with the market. But the Fed's ability to maintain its independence, and I know this has been laboriously underscored, is extremely important. And so it is absolutely true that the rest of the world is watching, especially the TCW that you just showed, the quiet quitting concept of U.S. Treasuries. Like if you look at yesterday, right? Yesterday was a day, a risk-off, geopolitically tense day with a concern about escalation of trade wars and concerns around policy in the bond market in Japan. What would usually happen is that the dollar would become a safe haven asset. That didn't happen. So there is a bit of decoupling in that. And there is a bit of, I also think, the expression of where gold has gone and the new highs that we've seen repeatedly are sort of a version of not holding treasuries, but not incrementally buying at the same pace that they have been before. And I do expect that we continue to see that a bit from, externally in the world.
All right, Alli, always a pleasure. Alli McCartney, Managing Director of Wealth Management, Private Wealth Advisor over at UBS Alignment Partners, counting us down to the closing bell with more than 80% of the stocks in the S&P, Katie Greifeld, in the green on a day that kind of defies a lot of expectations. A lot of people thought we were headed for another sell-off.
Yeah, absolutely. And as you said, we're not quite climbed out of the hole that we dug yesterday, but you are seeing that broad breadth. You have all 11 sectors of the S&P 500 in the green as well. So this is a broad-based rally.
A slight downtick in yields, about 5 basis points on the longer end of the curve. The VIX subdued as we break down all of today's market action and push ahead to what comes next right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Katie Greifeld, taking you through to that closing bell with a global simulcast. We're joined now by Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube on yet another chaotic and yet monumental day in U.S. and global financial markets. Markets hanging on every single word coming out of President Trump out there at Davos, Switzerland.
Yeah, as he moves around the globe, continuing to control really the narrative, what we keep covering, and where the market goes. And you're absolutely right. And I've been looking at something like semiconductors, some really mega outperformance throughout the day. We're looking at the stocks right now up about 3%. Intel is a big reason why. I'm going to talk about one of that. I'm going to talk about why. And maybe there is no reason, but they do report what is it tomorrow.
Maybe there is. Wow, that's a tease. Okay.
But we'll talk about it a little bit later on in my gainers.
I'm just trying to understand, do we call this, is this the return of the taco trade?
Are they whispering?
Yes.
Is that exactly?
Oh, yes.
Is that exactly what happened here?
Yes, it's exactly what happened.
Can we say
Did you
that?
see our red headline?
What is he chickening out from this time?
The tariffs.
Well,
I mean, he said he was going to propose tariffs February 1st. Then the red headline comes. You saw immediately spike in S&P futures, and we're off to the races.
But it's a framework deal, so theoretically, maybe there's some sort of win.
But the idea of a framework deal is like a term that's been used in the past. I mean, you go back to the debate that he had with Kamala
Harris
of a
plan.
Last year. Concepts of a plan for healthcare, exactly. So.
Yeah. Well, I mean, look, we make fun of it, but at the end of the day, 24, 36 hours ago, it looks like we were about to, go to war with Greenland and maybe with all of NATO and the European Union. And at least for today, it looks like the president has backed off that as he closes out his trip in Davos, Switzerland, heads back to the United States, and maybe a bit more of a focus on some of the domestic issues that continue to plague this nation. As for financial markets, a great day all around, recouping some of the losses from yesterday's sell-off. The Dow Jones Industrial Average up almost 600 points or 1.2%. A similar percent move higher for the S&P 500 and the NASDAQ. And the outperformer, once again, for a 13th straight session, it's the Russell 2000, up 53 points or 2% even.
Giving you some love today. All right, let me go back to the S&P 500. What's interesting is earlier in the session, we did see some pressure on most of these names. Right now, we've got 414 names in the S&P.
Remember that? What was that? David Bowie and who was
Under
the other
Pressure?
one? Yeah.
It was also covered by My Chemical Romance and The Used, which is a great version.
Pressure.
Nice.
Man, I don't think we have the rights to that, guys.
Romain's dulcet tones. 414 names in the S&P 500 higher today. 89 to the downside. Katie, take it away.
Let's talk about the Circle. It has so much good news today. It is completely green, a perfect score. 11 out of 11 sectors in the S&P 500 finishing in positive territory.
Is that a contrarian signal that I'm looking at right there?
We'll find out tomorrow. This is a much different picture than we were looking at 24 hours ago. What's leading in terms of a percent gain is the energy sector, higher by about 2.4%. But it was big tech that is adding the most points because that sector higher by about 1%. Your relative underperformer was utilities, only higher by about 0.2%. Consumer staples just a little bit ahead of that. But again, that speaks to this risk-on mood, Carol.
Yeah, absolutely. Speaking of that, Intel, here we go. I teased it a little bit, kind of pathetically, but here we go. Intel, your number 2 gainer in the S&P 500, number 1 gainer in the NASDAQ 100. Check it out, up almost 12%.
That makes sense.
Because?
I have no idea. I thought you were going to tell us.
Go back to singing, perhaps. Okay, so the highest intraday, no, actually the highest, I think, at the close here in about 4 years. As I mentioned, a top gainer in the major averages. So this one, for such a long time, couldn't kind of do anything right. We've seen quite a bump up. Check this out. It is up, I think, about 44% year to date. Year to date, what is it? January 21st. So that's pretty remarkable. Gained 84% last year. The company is going to deliver quarterly results Thursday, so we'll see whether or not it comes through. It's just been on a tear, so I had to point it out.
It's 47% year to date, and even if you go back to November or something, I mean, they were talking about a 60-70% rally, but that's a setup into earnings tomorrow. So it raises the question of what do they have to report tomorrow that's actually going to help maintain these gains? Otherwise, there's going to be a lot of people disappointed.
And I do feel like that might be the story among some of these companies that have been on a tear, right? I think we saw a little bit of that with even the banks, price for perfection and then some. Hey, Moderna, top in the S&P 500. Bernstein raised the target on the company to 35 from 25, maintained their market perform rating. This stock is up more than 60% year to date, highest in more than a year. You might recall yesterday that the company's a personalized cancer treatment developed by Moderna and Merck helped prevent the recurrence of high-risk skin cancer after 5 years. Some new data out that. So we're keeping an eye on this one.
Wear your sunscreen, people.
Okay.
Yeah.
Thank you very much.
It's important.
You're welcome.
You're singing, you're full of helpful tips. And this one.
I had a cream soda before I
Well, you know what goes good with a cream soda?
Yeah.
A Nathan's Famous hot dog.
Delicious.
Yes, this one rattling up about 8.7% in today's trade. Smithfield Foods said it would acquire Nathan's Famous in a deal valued at about $450 million, securing the rights to a key product in its business's largest segment. They had an exclusive license, so this goes out. But what's interesting...
$450 million?
Yeah.
For hot dogs?
Wow. A lot of hot dogs. A lot of buns.
Wait, what's interesting? I want to know this.
So it's connecting this New York icon, my husband loves Nathan's Famous, the fries are really good, to a company whose Chinese ownership has previously caught the attention of the Trump administration. So Smithfield, based in Virginia, its largest shareholder is Hong Kong meat processor WH Group Limited.
All right. I should go over well.
I was so close to asking Carol if I could do the gainers today just so I could do the Nathan
He's like,
story.
hey,
I was like, you got to do this.
do this one.
Tim, do you like hot dogs?
I like talking about that Nathan's is a
he probably eats like a veggie
publicly traded company.
You don't eat hot dogs, do you?
I do not partake.
I didn't think so.
Okay, let's talk a little bit about stocks that moved lower today. I want to start with Netflix. Shares fell earlier in the session, higher, fell rather more than 2.18%. But with all this buying, even Netflix got some buying late in the session. This after the company gave a disappointing forecast for earnings due to increased spending on programming, its deal for Warner Brothers Discovery. Netflix plans to increase spending on films and TV shows by 10%, and it secured streaming rights to movies from Universal and Sony. Once again, shares finished pretty much at their highs of the session, but still down 2.2%. Also, Kraft Heinz Company, Berkshire Hathaway, looking to sell its 28% stake in Kraft Heinz. It's the final step in a separation, months in the making.
See ya.
Shares of Kraft Heinz down 5.72% as a result of that. The move to exit Kraft Heinz comes just 21 days into Greg Abel's tenure at the top of Berkshire Hathaway. It follows a decade-long underperformance by the company. And finally, T1 Energy shares took a hit today, down 5.6% today. It's a small cap. It manufactures solar equipment, solar modules, sells panels, builds solar and battery storage. Fell as much as 15% earlier in the session. This after Culper said it's short the solar equipment maker.
Yeah.
In a post on X. Shares paired their declines, though, to fall just 5.6%.
And I'll just add a quick honorable mention to keep an eye on some of those software stocks, which continue to be under pressure. Microsoft, Salesforce down, software as a services, AppLovin down for a fifth straight day. Meanwhile, we did see a slight drop in yields on the day, trying to recoup some of the moves that we saw from yesterday of basically about 4 basis points on the longer end of the curve, shorter end of the curve. Basically not a whole lot happening there. Of course, the big focus today, Carol and Tim, really was on a lot of the stuff coming out of Davos and a speech by Trump that was actually supposed to be about affordability.
Yeah, and
it was a little bit about affordability.
A little bit about
Housing?
affordability, yeah, and TBD, I guess. We'll wait.
I
for
heard a
some
lot about
specifics.
windmills.
We did.
We're talking about that in just a minute.
We are indeed. Thank you for that.
Have you ever seen a windmill in China?
I have
Not in
only been
China.
to Shanghai, and I don't remember seeing any windmills.
What's that incredible wind farm in California, on the way to like Yosemite? You know what it is.
Yeah.
It's incredible. It's just like mile after mile of just
when I was a kid, there was that movie Less Than Zero with Robert Downey Jr. And I remember there's that great scene where, he overdoses when they're driving out through that windmill farm.
Huh.
Yeah, there you go.
Sounds like a trip.
All right. Anything else, guys?
Knight Swift earnings, want to do it?
Yeah, sure. Why not? I guess we got to do some work here. Knight Swift, of course, the big trucking provider, reporting earnings right now. That's crossing the wire here. The company saying revenue came in a slight touch below at the average of street estimates, $1.86 billion. The street was looking for about $1.9 billion. And EPS also a miss here on an adjusted basis, 31 cents a share. The street on average was looking for about 35 cents a share. It'd be kind of interesting to dive a little bit deeper into this because just a few days ago, we were actually talking about a bit of a rebound in the trucking market, of course, backward looking to the fourth quarter, so maybe it doesn't reflect that just quite yet.
All right, that's a wrap. Ramon's going to take us out, singing a little Under Pressure as we go on. That does it for our cross-platform radio, TV, YouTube, Bloomberg Originals. Tim and I continuing right here on radio, and of course, Katie and Romain continuing there on the close on Bloomberg TV. Folks, we will see you again, same time, same place tomorrow.
When we come back, we continue our coverage here on Bloomberg Television, a discussion about the 2026 outlook for private markets. David Sambur, partner and co-head of equity over at Apollo. He joins us next. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romain Bostic. Katie, there was some interesting data yesterday coming out of JP Morgan about all the retail traders that flooded into the market during yesterday's sell-off. And, well, a lot of those folks turned out to be right. A big dip buying day here for the S&P 500 and all the major indices. Now, we did not recoup all of the point losses from yesterday, but certainly made some great strides towards it. The S&P closing up about 1%. The Russell outperforming for a 13th straight session, up about 2%. But there still is a bit of a defensive tilt to this market. Gold at one point during the session at another record high on an intraday basis. And Katie, I don't know if you know this or not, but it's cold outside. All along the East Coast down to the Gulf. Natural gas futures here in New York having their biggest one-day jump since 2022.
And it's only going to get colder. I am not looking forward to this weekend. But let's talk about some of the individual movers in the equity market today. I wanted to start with NVIDIA. No real catalyst other than President Trump calling off those February 1st European tariffs that caused chip makers to rise broadly. NVIDIA up by 3%. Intel up even more, now at its highest level in about 4 years now. Again, no specific catalyst, but this company's reports earnings tomorrow, basically 24 hours from now. So we'll see exactly how high the bar is. And then Kraft Heinz, we were talking about this a little bit in the simulcast, down about 6% on the day. You had Berkshire Hathaway basically cutting its losses, looking to get out of its stake. But our top story this hour is executives descending on Davos as public and private markets take center stage. Morgan Stanley CEO Ted Pitt cautioning that major private tech firms, quote, are not rushed to go public. Meanwhile, you had NYSE President Lynn Martin expecting tremendous activity for IPOs in the coming weeks. She spoke with the Bloomberg surveillance team earlier today.
The private markets have done a good job in financing these companies and enabling these companies to continue to build, to innovate, to refine their strategy. But there isn't a substitute for the public markets for the long term.
And that is a sentiment being echoed by quite a lot of folks, including earlier today on this show out of Ken Kencel over at Churchill Asset, including also Bill Curtin over at Hogan Lovells. Joining us right now is David Sambur. He's the partner and co-head of equity at Apollo. Joins us here in Studio 2. Great to see you here.
Good to see you.
Are you just as optimistic for this year?
We're always pessimistic by nature at Apollo. We're worried about things that are going to go wrong. I do think in the near term you're going to see a pickup in deal activity. I don't know if it'll be as robust as people are hoping for, but look, last year was a huge year for M&A, 40% increase year over year in global M&A, 35% increase in sponsor M&A. I think you're going to finally see some deal activity.
Do you think it's going to be an increase in overall value of deals or an increase in the overall number of deals, or both?
I think both. Look, if you look at the financing markets are incredibly tight no matter how you look at it. Credit spreads are tight, primary markets are open. The equity market, which you were just talking about in the segment leading up to this, is starting to open up. Last year was a pretty big increase, but still below where it's been historically. But all those indicators are pretty positive. So I do think you'll see a pickup.
Well, I'm curious, how the sort of geopolitical volatility, the tariff, it's on, it's off, that sort of volatility is impacting the way you invest at all in any form over the past year or so.
The answer is it has to, because especially for us, we don't have the benefit of liquidity, so we need to assume we're going to own these businesses for 3, 5, maybe even 7 or 10 years. So we have to take not only a short-term view, but a long-term view. And anytime you're seeing these big changes in things that you're assuming, it impacts your ability to underwrite deals, 100%. The way you solve that, the way we solve that, is by always being focused on risk mitigation. The strategy we use for risk mitigation at our firm is purchase price. So we're always focused on creating some margin of safety, because the reality is that there's always uncertainty. It's just sometimes people under-discount uncertainty. And we're living in a pretty uncertain world right now.
It's such an interesting point, because you think about basically the public equity markets just sort of brushing off a lot of these tariff concerns. But of course, in your environment, the private markets, impossible to ignore. I do want to talk about the fundraising environment a little bit, because my understanding, Apollo is looking to raise about $20 billion for your latest flagship. What has appetite looked like so far?
I think you're seeing a consolidation of managers, and you're certainly seeing a shakeout that, frankly, I've been waiting for, because this is a market that lost its way. If you look at private equity managers over the last 15 years, a lot of people were selling what they thought was alpha, and in retrospect, it was highly levered beta. When rates were going down over the last 15 years, essentially to zero prior to 2022, that masked all sorts of loss of discipline, and you saw valuation multiples expand. Valuation multiples and revenue drove 99% of industry returns from 2013 to 2023. That is not what private equity is supposed to be. Now that rates are up, it's been harder to exit companies. Returns have been coming down for a lot of managers, and rightfully so. Investors are saying, why should I lock up my capital with you if you're not handily beating the public markets? And the most important part, people haven't been returning cash. This is a cash investing business. People somewhere along the way forgot the most important thing we're supposed to do, which is take $1 of our investors' capital and return $3 within 5 years. People forgot to return the money, so I think that they should be punished.
Well, this kind of circles back to the original question, though. When we talk about the increase in deal activity, how much of that is, and forgive me for using this phrase, almost forced selling? The idea that there are some people that have to sell because they need to get that cash back to the LPs.
I think there's certainly part of that. The inventories are stocked with private companies. There's essentially $5 trillion of equity locked up in private companies. Now, that doesn't tell you very much because a lot of money was raised and a lot of money was put to work. But going back to what I was saying, you need to sell. And the longer you hold these companies, usually the returns come down. And we're reaching maturity for deals done in 18, 19, and 20 where people do need to sell. Now, they're selling into a stronger market environment, but the final report card isn't out. We will see. We will see what the final returns are in those deals.
What is the private equity model now? A model, of course, that Apollo helped to pioneer, but we know that it's shifted. I mean, we've seen that in some of the moves that Mark Rowan has made at the company here. What is that model right now?
So private equity is just a small part of what our overall firm does. Our firm is a financial provider of private assets and public assets globally. Where we really excel is by providing capital for long-term needs, whether it's in the equity markets where we have a longer-term view than the public equity markets, or where it's in the credit markets where, again, we're able to provide a longer-term view than daily traded public credit.
And I mean, when you take a look at those two different asset classes, those two different markets, you have private equity, you have private credit. I mean, which do you feel better about at this point? Where are you seeing more opportunities at this point in time?
I mean, we're seeing more opportunities in both. I'd be lying if I didn't tell you the last 3 years, if you look at the industry, private credit has been the place to be. Private credit returns have been very, very strong, and the asset class has raised a good amount of money, including us. If you look at our private equity business, it's continued, I think, to excel. And I think as you head into this environment where rates are higher and you have to get back to basics, buy a company at a good price, improve its operations, make it grow faster, and then exit it, that kind of plays to our strengths. This is an alpha market. This is not a beta market.
Well, you take a look at 2025, you had a number of exits in the form of IPOs last year. Aspen Insurance comes to mind. When you take a look at the landscape of 2026, I mean, can you pinpoint any sort of range, any sort of number of exits that you're hoping to, put through this year?
I'm expecting this year to be a bigger year than last year, and we did pretty well compared to other folks. You mentioned the IPOs. People ask me all the time, why aren't there exits? Why aren't there exits? There aren't exits if you've overpaid. Simply put, you could take companies public in 2025. We were pretty early in doing so because we had the flexibility. We didn't have these handcuffs around us because we bought companies at reasonable values. They hit their business plans, and we had the flexibility to exit in an environment that, I'll be honest, was not a great environment. But because we kept our discipline, we were able to exit. I think in an environment that's easier, which is what I'm seeing currently, you're going to see a pickup in activity.
Well, that's what I'm curious too, about the easier side of this environment. I mean, most people think that monetary policy will get more accommodative. There's been a lot of talk about regulatory policy already being accommodative and potentially maybe some fiscal tailwinds, given that it is an election year, at least here in the U.S., and you have a lot of folks wanting to sort of grease the wheels a little bit. Is that going to aid some of the decisions that you make this year in terms of new investments and new opportunities?
I think it does, but also the negative volatility is our friend too. You know, you look at what happened in the market over this past week. You talked about in your segment earlier today, retail came in and they saw an opportunity. You extrapolate out the volatility over a couple of weeks, I think that creates an amazing buying opportunity. So I think you have to be good at buying and selling. And we're going to see, it's early days. We're in the first month of the year. Let's see what the year has in store for us. I see a strong economy, and we're excited about that. But there's going to be volatility in the markets, both up and down. There always is.
You've got to be good at buying. You've got to be good at selling. When you put it that way, it sounds pretty simple. David, it's great to get some time with you. Really appreciate you stopping by. That is David Sambur, partner and co-head of equity over at Apollo. Now, coming up, President Trump's credit card cap could spell economic disaster. That's if you ask Jamie Dimon. We'll discuss those comments next. This is The Close on Bloomberg.
It would be an economic disaster. And I'm not making it up because our business, we would survive it, by the way. You would, if you, in the worst case, you'd have to have a drastic reduction of the credit card business. I mean drastic, I mean like 10%, I mean like 80%. It would remove credit from 80% of Americans, and that is their backup credit.
And that was JP Morgan CEO Jamie Dimon speaking at Davos earlier today, warning that President Trump's proposed credit card cap would be an economic disaster. Here to discuss is Katherine Doherty. She is Bloomberg's finance reporter. And Diamond did address this, but it's in his economic interest to paint a dire picture of what would happen if we did see this cap instituted.
Yes, but it also echoes all the commentary that we've been hearing from executives at the big U.S. banks, from Capital One, all of the major credit card issuers. They are saying that they would be required to change their own lending parameters, which would restrict who they are lending to, which would presumably cut off many credit cards across the country. Today, hearing a little bit more about that actual number, Diamond putting the 80% on it. We haven't heard as many, even as of last week during the bank earnings. There wasn't specifics that were given, because at that point, the executives were still trying to understand, is this a law that is going to be put in place? Is this something, when they talk about a deadline of January 20th, what happens if we are not abiding by that deadline? So we're getting a little bit more details today, with Trump following up after the comments that we just listened to from Diamond. He is saying that he would want Congress to act on this credit card cap. And that's a very different approach than an executive order.
I gotta tell you, so I was at a watch party for this morning. And one of the investors there, I did not, actually. I did not really even want to be there, but it was just kind of serendipity. But it was funny when he mentioned the going to Congress, and it was just kind of almost a quick throwaway line. Everyone in the room seized on that. It was almost like, oh my gosh, okay, that's kind of what you want. But it gets to this idea too, as to whether this fight is really over. Like, can the credit card companies kind of breathe a sigh of relief? It is an election year. A lot of people on both sides of the aisle are going to want to do something to make it look like they're trying to, fight, the affordability crisis. And this seems like low-hanging fruit if they do want to go for it.
Well, you say everyone, or breathe the sigh of relief. It's really the bank executives. It's those that have been trying to wrap their head around, how do we approach this? It's, again, a very different process, having to go up against the president himself, the administration, versus an entire process of getting something passed through the House, through the Senate. Right. And that is something that the bank and their lobbyists are very used to. Oh, yeah. So that is the sigh of relief. And you even saw it in the market today. Many of the bank shares are either up or flat just today, because of that change in what potentially they were getting scrutinized for during bank earnings last week. This was a huge topic of conversation that in many ways clouded the money, the profits that they were able to make during 2025.
Well, to that point, Capital One, I believe, reports tomorrow. We heard from Diamond saying that JP Morgan would be fine. They have a diversified business. But for more of those pure play card companies, what would this mean, theoretically?
I think there's two different major profit engines for these card companies. One is this interest rate that they are getting for those that are not paying off their credit card bills, and the other is the interchange fees. So we have to remember that that's another very lucrative part of the business. And in many ways, that is how they fund their rewards programs. That's how you're getting to pay for flights using credit card points. All of these things are very important to the consumers, especially on the higher end, that are paying up for credit cards, that they want more access to lounges, things like that. So I think that those are the two metrics that have been scrutinized, and there have been a lot of legislation that's been brought up with regards to those interchange fees. And now with the interest rate cap, that's the other new topic of conversation. And I think that that's the one that is still there's a lot of work that needs to be done to see and to quantify the impact.
Katherine Doherty, Bloomberg reporter here. A closer look here at that potential credit card rate cap that, of course, at least for right now, seems to be put on hold. When we come back after the break, we're going to talk shareholder activism with Jim Rossman over at Barclays. This is Bloomberg. Global activism coming off a record year, posting 255 campaigns, the U.S. accounting for more than half. Those are just two of the many top lines from Barclays' latest review of shareholder activism. And it points a lot of questions here about what's in store for 2026. Jim Rossman is the global head of shareholder advisory over at Barclays, and he joins us here in studio too. Great to have you, Jim.
Yeah, thank you for having me.
Let's first start off with those 255 campaigns here. What actually drove that?
Record number of campaigns. I've been keeping track of these statistics for over a dozen years. I think the main thing was that we had a lot of uncertainty in the first half of the year, a lot of disruption, which caused a lot of companies to be undervalued. And that provided an interesting entry point for activists who look for undervalued public companies. And that sort of maximum uncertainty was followed by maximum certainty, which is the M&A markets opened up. And for years now, M&A demands have been the top campaign objective of activists. So as the M&A market goes, activism goes. So that was really the sort of the fuel on the fire for this year.
I'm curious, though, 255 campaigns. Are those 255 successful campaigns?
It's an interesting question. I mean, measuring success is hard. What I try to do is look at how many board seats did activists actually garner during the course of the year. It was 120 this year. There were 52 settlements. So if you look at those 255 campaigns, 20% of them settled without even a fight. And there were 32 CEO departures on top of that, which was the highest number I've ever seen. Compare that to about a dozen historically. So in terms of success, that's one of the measures.
So beyond just the number of campaigns, it's interesting to look at who is staging them. And you highlight Elliott, once again, launching 18 campaigns in 2025. When it comes to activists, they are uniquely active in this space.
I think what's happened is we now have two markets. We've got Elliott and everyone else. Elliott has close to $80 billion. They can run they ran 18 campaigns. They're putting $1 billion to $4 billion to work in almost every campaign. And then there's everyone else. And if you actually look at those board seats that I talked about, Elliott plus Starboard, I think, won 30% of the board seats.
Wow.
So there's Elliott. If they show up on your door, that's one defense plan. If it's the other 140 activists, that's another plan.
Yeah, if they show up at your door, maybe just move. But I do want to get your thoughts on what we're seeing when it comes to some of these proxy advisors. ISS Glass Lewis, they've caught the ire of the Trump administration. You see reporting that JP Morgan plans to cut their ties, move to an AI model. Have you seen any sort of impact when it comes to these shareholder campaigns from the fact that it seems like these proxy advisors are being de-emphasized?
Yeah, it's a great question, and I'm getting it almost weekly these days. I mean, frankly, I think it's a lot of noise. If you actually, again, look at those 255 campaigns, the 141 in the United States, most of the proxy fights, which actually go to a vote and depend on ISS and Glass Lewis giving their views, there's about 9 of real importance. So 9 out of 255. So I don't think the overall impact on activism as a tactic is all that great. And if you look at the ISS and Glass Lewis support for activist nominees at those 9 fights, they've supported 2/3 of the nominees, but only 1/3 got elected. So, are they relevant? Do they put out research that investors like to have? Frankly, yes. Will they have that big of an impact when it comes to making a decision about launching a campaign? I don't think so.
Can you talk a little bit more about the interplay between what we're seeing with the pure play activist investors and the M&A community? When we've been talking today a lot about the outlook for M&A, and everyone we've had on this program has been pretty bullish about the amount of deal activity we're going to see in that space. Is that going to actually maybe fuel more activism this year?
I think that one of the major outlooks for 2026 is that M&A is going to continue to fuel shareholder activism. And I'm going to give you an interesting statistic. In the first half of the year, when M&A was uncertain, 34% of the campaigns led with an M&A objective, sell the company, sell an asset. Second half of the year, 51% of the campaigns. Fourth quarter, 61%. And so think of the two areas where I think everyone's talking about M&A expanding. The middle market, right, away from the mega deals. And the second is private equity take privates. And that's also another area where I think we're going to see more activist activity, is that for years I was saying private equity would get more involved in shareholder activism because activists were kind of eating their lunch by getting in early and keeping the companies public and capturing the returns. So I thought maybe there would be competition between private equity and activists. Actually, what we're seeing is more alignment, where activists are sort of the early, the first movers who are identifying the good take private candidates, and then private equity steps in.
Well, it's a fascinating world. It's great to dig into some of these details in this report with you. Jim, come back soon. That is Jim Rossman. He is Global Head of Shareholder Advisory over at Barclays. Meanwhile, let's take a quick look at how markets closed on the day on this Wednesday, because there was a holiday on Monday. The S&P 500 higher by about 1%, but as we've been talking about, Romaine, not quite out of the hole that we dug yesterday with that 2% decline.
Yeah, not out of the hole here, but the same market narrative still kind of holds, which is this idea of kind of a bit of a rotation out of some of the more high value, big cap names and into something, I guess, on a relative basis, more of a bargain with the small and mid caps.
Yeah, and I feel like that was legitimized with what we saw yesterday, the small caps declining less than the S&P 500. In any case, you also saw gold rise once again, and natural gas, keep your eyes on it.
It's cold.
Up about 27%. Yeah. This is the close on Bloomberg. Well, our next guest is a huge name in Chinese real estate. Some call her the woman who built Beijing. Now she's bringing her expertise stateside, recently purchasing land on the Upper East Side to develop luxury condos. Joining us live for more on her plans in the U.S. market, I'm pleased to say, is Zhang Xin. She is the founder and CEO of Closer Properties and former CEO of Soho China, where she currently serves as an executive director on the board of directors. To start, it's great to see you in person.
Good to see you.
Before we get into what you're seeing specifically in New York and specifically on the Upper East Side, talk to us first about the journey from China to the U.S. property market and what that transition was like.
Well, I was CEO for Soho China for 25 years and built buildings mainly in Beijing and Shanghai. And over global financial crisis, I started investing in the U.S., mainly as a way to diversify risk from China. So I really got into the U.S. real estate from 2009, 2010, but pretty passive, mostly as LPs or as owners of the buildings. And recently, since COVID, I relocated to New York, and I've been looking at development opportunities and started thinking, what can I do? And the city seems to be starved with all kinds of housing, all segments of housing, from affordable all the way to luxury. And I just see that people love to live in historic district, Upper East Side, Upper West Side, West Village, downtown, and yet, if you look around, the buildings are old.
Yeah.
And people want to be living in amenitized new buildings with service. So that's what we decided to do.
Not to give you my life story, but I just moved to Hoboken, but I lived on the Upper East Side for 10 years.
Oh.
I loved it. So the plan to develop luxury condos, I mean, the Upper East Side is pretty crowded. There is an overall housing crunch overall, but what will be your differentiating factor?
Product. It's always a product, right? The location is important. We've chosen historic district, Upper East Side, but most importantly, the product has to be what people want. I mean, I've spent a lot of time doing design, architecture design, interior design, and so really we're excited to bring something fresh to the market.
I am curious, though, too. I mean, we talk about the parcels of land that you found on the Upper East Side here. I mean, there's a reason why we have a lot of old buildings, because there's not a lot of, empty land. It's certainly not in Manhattan or some of the more central parts of the city. So unless you tear something down, it's hard to even build something new. What does the price discovery look like in finding something that's going to be affordable, at least, affordable in the sense of a return on your investment?
It's one of the reasons you see that there's been so little supply of new apartment buildings is because it's expensive to build. It's expensive to buy land, to assemble land. It's also expensive to build because of the inflation. The cost of building is so much higher, cost of capital is so much higher, right? So that's one. I actually just came out from this morning's brokers' report on last year's market. Pretty much the walkway was there's such a lack of new development supply. And I think that's because the cost of building is high.
I mean, you made your mark primarily in commercial real estate, at least when you were doing your work in mainland China. Compare and contrast that with doing a residential project, particularly here, not only in the U.S., but in obviously one of the hardest real estate markets in New York City.
Well, it's quite different. The scales is very different, right? New York City, the prices is high, but the scales are smaller. You know, we're talking about these boutique buildings that we're building with 30 to 40 units, whereas in China, the scale will be 10 times, if not 20, 30 times, much, much bigger scale. But New York City is very well built, already so dense, right? So anything you want to build new, it just takes so much to assemble land. You know, you have to, I mean, this piece of land, it's like we bought it 5 different pieces of land put together. And so that just goes to show you how hard it is to build in Manhattan.
And what you're building right now, will these be to sell or rental properties?
To sell.
Interesting.
Yeah.
And what kind of buyer base are you seeing come in? I mean, are we talking about, you know, domestic, New York buyers, or are you seeing international interest as well?
I think primarily New Yorkers, because that location, Upper East Side, is very much a New Yorker with families, with a lot of great schools around that, families with children go to schools in nearby, professionals, and that's the key. That's, I think, the prime market. There would always be some international buyers because it's New York. You know, New York is the primary location for international buyers. But I think if you look around, that those international buyers are mostly concentrated in those super tall buildings rather than these boutique historic district buildings.
I mean, your business, you also have a portfolio of non-residential buildings,
Right.
including the GM building down the street. I am curious about the difference between what you're seeing right now in, say, the office and commercial real estate market in New York City relative to the actual housing market.
Well, I give you a different markets. Like we built a building in Boston, an office building in Boston during COVID. In the beginning of the COVID, you remember this life science was so hot, right? So Boston office, Boston commercial market was so hot. So we built a building. And then what we did not know was that interest rates started going up, and that really hurts life science industry in Boston. And it also hurts the commercial real estate. But New York, because of the financial institutions are back and going strong, you know, last year we saw the best leasing market in Midtown Manhattan. So that's why we are doing very well. And so if you look at these two markets, just Boston and New York, commercial real estate, New York is doing significantly better than Boston.
Yeah. Do you worry at all about some of the political issues and how that affects what markets might do better than worse? I mean, Boston has also had some other issues recently because of the pulling of some federal funding for a lot of those life sciences industries, and that's caused a bit of a retrenchment as well.
You know, it's interesting because if you look at New York City, New York Manhattan's apartment sales in the last 25 years, with the 2 exception years, which is global financial crisis 2008 and COVID 2020, that really went down significantly. Otherwise, every year it pretty much sells between 10 to 11,000 units. It's very resilient, the market.
All right. Well, this is a great conversation. It's really great to meet you
Great
as
to meet
well.
you.
And interesting to kind of see your continued success here in the U.S. and particularly in New York City. Zhang Xin there is the founder and CEO of Closer Properties and the former CEO of Soho China, where she is currently an executive director of the board. When we come back, we're going to continue talking about the real estate market and take a closer look at the health of commercial real estate with a $74 billion leader in that space. Josh Pristaw joins us after the break from Clarion Partners right here on The Close, right here on Bloomberg.
Homes are built for people, not for corporations, and America will not become a nation of renters. We're not going to do that. That's why I have signed an executive order banning large institutional investors from buying single-family homes. It's just not fair to the public. They're not able to buy a house. And I'm calling on Congress to pass that ban into permanent law, and I think they will.
An excerpt from President Trump's hour-long speech at the Davos World Economic Forum earlier today, reiterating his intent to move forward here with a crackdown on institutional home buying, maybe potentially cementing that with an executive order. But we also just got some data out there on pending home sales in the U.S. They did fall the most since April of 2020 in December, even as home purchase applications climb back to 2023 highs. So there's a lot to unpack here as to what exactly is going on in the U.S. real estate market. So who better to do that with than Josh Pristaw? He's president and managing director over at Clarion Partners, which has $74 billion in real estate assets. Great to have you here.
It's great to be here again. Thanks for having me.
Let's just first start off. We might as well start off with Trump's comments here. I mean, obviously, he floated this idea of cracking down on institutional buying of single-family homes a couple of weeks ago here. Obviously, this is a long way from being implemented. We have no idea what it's going to look like. But what was your reaction when you saw that? Because he is, in fairness to him, trying to address a problem that I think a lot of politicians have seized on.
Sure. Well, I thought you might ask me that. And first, I'd say we applaud the president and the administration for trying to tackle affordability. And if you think about one issue that there's almost universal consensus on is that housing is expensive and we need more of it. I think I agree with you that we need to see more as it evolves over the next 30, 60 days. I was heartened by the fact that there seems to be an exception for build to rent. That's purpose-built new construction of single-family homes in the executive order that came out last night. And any solution probably needs a supply-side approach to it, which is, that's what that is building new homes to add incremental supply for consumers. I think maybe the more interesting thing that we're focused on is the demographics. And when I was here last, we talked about this because the home ownership rate is actually the same as it's always been historically, about 65%. What's different is that baby boomers own a lot of homes and haven't been selling them. So about 80% ownership rate amongst baby boomers. We're at Clarion, our highest conviction idea is healthcare real estate, particularly senior housing. And we're looking at the other side of that trade as people turn 80. There's 10,000 of them every day turning 80. People sell their homes and look to move into assisted living, senior housing. And there's a tremendous demand for that.
So you think that's going to be where a big part of the growth is? And that's just what, a function of us living longer and things like that?
I think it's two things. I think it's longevity and it's wealth. I think people have been able to stay in their homes longer. And I think as there's about 25 million homes by people that are owned by people over 75. As those are sold back into the system, I think that will ameliorate some of the affordability issues for families, entry-level home buyers. On the investment side, we think the highest growth from a cash flow standpoint that we see is going to be in senior housing.
Well, I want to talk a little bit more about specific sectors. So you have a lot of conviction when it comes to senior housing within the healthcare sector. You sent us over a PowerPoint, which is really interesting. I'm looking at.
We like to be prepared.
I'm looking at one of the graphs in here, your vacancy rate by property sector, and by a mile, it's life sciences, that vacancy rate well above its historical average here. So what exactly is going on when it comes to the life sciences?
Sure. Well, overall, when you look at the commercial real estate market, most asset classes are incredibly healthy. So if you look at the long-term average of things like vacancy, new construction starts, and absorption, it's really a positive sign for the start of a new cycle where we expect returns to look really good on a historical basis. There's a couple sectors, office and life science, that have elevated vacancy. Life science in particular was a very small base that really coming out of COVID and during COVID, there was a lot of supply that was built, and so off a very small base. So there's a high degree of vacancy. But what we see broadly in healthcare with this surge in the number of 80-year-olds is there's going to be demand for all kinds of healthcare services. So we talked about senior housing, think medical office, think rehab facilities, and also ultimately life science. So our research suggests that long-term life science is actually a pretty good place to be for the right assets.
Interesting. I mean, how long do you think that cycle is? Because again, you take a look at the vacancy rates, I think it's about 35%, between 30 and 35%. When does that return more to its historical average of around maybe 11%?
Well, the really interesting thing, you mentioned Clarion manages about $75 billion of assets, overwhelmingly in core plus, long-term evergreen vehicles. So we really have the privilege of being able to think long-term. And when you look at life sciences as an example, it's pretty choppy for the next 2 years. But over 10 years, when we look at our model portfolio, it is one of the higher returning assets. But it's not really an area we're looking to add exposure right now. We're really looking at industrial, healthcare, and housing as our top convictions for 2026.
All right. Well, we got to get you back a little bit later in the year and see how things are going. Always great to catch up with you. Josh Pristaw is the president and managing director of Clarion Partners. A closer look here at the real estate sector as we wrap up our coverage here on The Close and set you up, Katie Greifeld, for what to watch over the next 24 hours. Hopefully, it'll be a little less busier tomorrow, but we do have some earnings first thing in the morning that we're going to have to parse through.
Absolutely. We're talking about General Electric, Procter & Gamble, just some of the headlines.
Don't forget Freeport-McMoRan.
Well, I wanted to hear you say it.
Okay, yeah, I just like saying Freeport-McMoRan.
That's before market.
Yeah.
That's before we get on air.
All right, well, aftermarket.
Aftermarket.
There we go.
It gets hot.
Pronounce
Intel.
that one.
Intel,
Right.
Capital One.
CSX, Alcoa, Intuitive Surgical. Capital One could be interesting given all the debate around a credit card rate cap, and of course Intel. That stock has been on fire, up 60% just over the last couple of months alone.
Yeah.
High expectations heading into that print.
Yeah, we'll see. Certainly a high bar that even just today's session.
Do you care about GDP?
Company. A little bit. That comes out at 8:30 a.m. I'm somewhat interested. Also interested to see PCE coming in hot at 10 a.m. as well as personal income and spending.
Well, hopefully it doesn't come in hot. Jay Powell's a favorite inflation gauge
on
there.
who you are.
And also just keep in mind, too, I kind of forget about this. TikTok, remember them? A U.S. joint venture expected to finally be formed.
It's my most used app.
You're going to remember where you were there on January 22nd, 2026. Balance of Power is up next. This is Bloomberg.